Open-ended bond funds are a type of non-bank financial firm that invest in instruments such as corporate and other bonds and allow investors to redeem their shares for cash on a daily basis. The market turmoil in March 2020 revived concerns about these funds. Because bonds are less liquid than cash, open-ended bond funds need to manage the risk of large investor redemptions such as those seen during the turmoil. They do so by using two lines of defense. The first comes from cash and other liquid buffers. A fund can pay out cash to redeem investors with little transaction costs. During the turmoil, bond funds did pay out, but then actually sold more bonds than were needed to cover redemptions, increasing their cash buffers as risks were mounting. They therefore sold less liquid bonds into already strained markets. This worsened liquidity. Bonds offloaded by high-yield bond funds, for example, suffered larger price declines and worse liquidity conditions than comparable bonds. The second line of defense tries to make investors bear the cost of their redemptions. Swing pricing, for example, allows a fund to lower the price it pays for redeeming shares, thereby reducing investors' incentives to exit. Swing pricing was actively used during the turmoil, but did not seem to slow down redemptions. So what is the bigger lesson of the turmoil? We have seen once again that decisions that are optimal for an individual firm can collectively add to market stress. Regulation should thus ensure that individual market participants incorporate system-wide considerations into their risk management. In this regard, systemic or macroprudential tools could make bond funds more resilient by reducing procyclical behavior.